Good afternoon and welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at MarketSite is Dodd Kittsley. He's a director over at Davis Advisors, and we're going to discuss one of the hottest topics on Trade Talks, and that's active management in the ETF industry, driving future growth. Thank you very much for joining me at MarketSite today. So tell us about Davis actively managed ETFs and how they're different from smart beta ETFs.
Well, thanks for having us, first of all. Yeah, we're really proud to be the first or among the first to combine true time-tested active management in a traditional ETF structure. So Davis ETFs, in a nutshell, provide all the benefits that traditional ETFs have: the tax efficiency, the transparency, the trading flexibility, but they also bring you true active management. And our firm is very focused, research-driven, selecting stocks from the bottom up. And we're time-tested in that we've been managing all these strategies for decades, and all of our strategies have outperformed their benchmark and peers since inception. So it's really compelling.
So, and this is different from smart beta ETFs because it's not so model-based? Is that the difference?
It's not model-based. So the big difference is we're not based on an index, right? So securities are selected, again, one by one, hand-selected, and they're weighted by conviction in how we feel about those securities. So very different than smart beta, because the value that Davis has brought to investors and what we offer, and what's driven our outperformance historically for shareholders over time, is something that couldn't be distilled into a predetermined set of rules. It's qualitative in nature. Right. It's things around management's ability to allocate capital. It's about competitive moats. It's about the competition. It's checking with customers. So each one of these companies in our portfolios, we deeply research years before it even comes into the portfolio.
And you just touched on this a little bit already, but active versus passive continues to be the biggest debate in the ETP industry. Yep. Can active outperform? You just mentioned that it can. And why do you think passive has consistently beat the average?
Yeah, I'm glad you asked that. It's such an important topic. And being on the indexing side for almost 20 years, it's a unique perspective I have, but I really feel the pendulum swung so far in the passive camp that conventional wisdom is just that, right? That active can never outperform passive, and that just isn't true. It's not true on a lot of different levels. First, if you look in international markets, over the last 10 years, 84% of active managers have outperformed the MSCI All Country World ex-US. 5 years, 70%. 1 year, over 70% as well. So you got to look at different markets. But in the US, certainly what helps explain why so few managers have outperformed the index is we've been in this momentum-based bull market that really favors market cap weighted indexes. But we know it's cyclical, and when things turn, certainly we believe investors are well suited to have and reserve a place in their portfolio for active management that could be very valuable from a diversification standpoint.
And really, since the peak of passive investing, we really haven't been through a volatile cycle in the market, so we haven't even tested that yet. But
yes.
ETF selection is one thing. How do you select the right manager?
There are 4 key things to really look when selecting managers. This is really important because there's a lot of bad active management out there. So what do you want to look for? You want to look for managers with experience and a strong track record. You want to look for managers that look different than the benchmark, right? If you can get the benchmark at 3 basis points, you don't want closet indexers there. You want folks with high active share. You want managers that are going to be aligned with investors and have co-investment. That's so very important. And obviously reasonable fees as well. It's really interesting because Capital Group did this study 2 years ago, and it should get a heck of a lot more attention than it has. But they essentially looked at the US market over the recent period, and by screening that set by lowest quartile for fees and highest quartile for co-investment or insider ownership amongst the manager, 89% of managers outperformed over 10-year periods over the last 20 years. Not 24 like Spiva would lead you to believe.
All right, well, let's talk about the market. Where are you finding value in today's market, and what are your long-term thoughts on it?
Well, we see huge opportunities outside the United States right now. Not to say that they're not great pockets of value in the U.S. and, say, financials and select energy companies, but if you look beyond the U.S., it broadens your opportunity set dramatically. 95% of the population is outside the United States. 90% of all listed stocks is outside the United States. 75% of GDP. So what we're trying to do, and we're finding some great entrepreneurial, innovative companies overseas that are capitalizing on these decade-long tailwinds or trends, such as the growth of the online consumer, the need to transport people and packages, which is growing at such a dramatic rate. So that's what our portfolios are really trying to capitalize on, is the best companies with very strong tailwinds.
All right, and to wrap up, what's the future for the ETF industry?
Oh gosh, it's a very bright future, right? I mean, I think we're going to see a continuation of the great things that ETFs have brought, transparency, driving down fees, really democratizing investing in making strategies and markets broader. But I think the thing that I think people are going to realize in 2018 and beyond is that ETFs aren't just about indexing. What they're really about is delivering a more efficient way to get at exposures. And those exposures could be markets, they could be smart beta type of stock screens, and they can even be strategies such as active strategies. So I think active is really going to be one of the engines that's going to continue to grow the industry alongside the other great solutions.
All right, well, thank you very much, Dodd, for joining us at MarketSite.
Thank you.
Thank you for joining me throughout the day. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.